Meet Ryan. Ryan owns his own business, Stamps and Ink, where he creates custom stamps for businesses. Ryan normally has an accountant that handles all of his finances, but for the last 2 weeks, that accountant has been at home sick. Because the financial aspects of the business still need to be tended to, Ryan decides to do the calculations and complete the books himself. He begins by looking at all of the different costs of his business. For example, he has the costs of the machines he rents to make the stamps, the boxes needed to ship the stamps, and the mortgage payment for the building. But Ryan quickly becomes overwhelmed because he's not sure where to place each cost. Which ones stay the same? Which ones change? And which ones are mixed costs, which combine both fixed and variable costs? In this lesson, we will learn more about mixed costs and how to calculate them. As we now know, a mixed cost is made up of fixed and variable costs. Let's look at these in more detail. Fixed costs are those costs that stay the same regardless of production. In other words, a fixed cost does not change no matter how many goods or services a company ends up producing. For example, the mortgage payment for the building where Ryan operates his business is a fixed cost. Whether he makes 5 stamps or 5,000 stamps, Ryan still has to pay the same mortgage payment each month. On the other hand, variable costs are those costs that change based on production. As the number of products a company makes increases, the costs increase as well. If the number of products produced decreases, the costs also decrease. An example of a variable cost might be the cost of the boxes Ryan needs to mail the stamps. If Ryan makes 100 cases of stamps, he will need 100 boxes to mail out those stamps. If Ryan only makes 2 cases of stamps, he will only need 2 boxes. Obviously, the more stamps Ryan makes, the more boxes he will need. The more boxes he needs, the more money it will cost to purchase those boxes. The same can be said as production decreases. Fewer stamps means fewer boxes and lower costs. So, when we combine both types of costs, fixed and variable, we have mixed cost. In other words, a mixed cost has 2 components, a fixed component that does not change, and a variable component that changes in relation to production. An example of mixed cost is the rental of the machines that Ryan rents each month. If he has agreed to rent the machines for a base cost of $200 a month, that is a fixed cost. Ryan has to pay $200 regardless of the number of stamps produced. If he has also agreed to pay $50 additional for every 100 stamps produced, that is a variable cost. That is because the more stamps produced, the more money Ryan has to pay. So, if we combine the 2 types of costs, we have a mixed cost. Let's take a look at another example. If we look at the ownership of a car, for example, we will find all 3 types of costs. First, there are fixed costs. Those include the car payment and insurance. Neither of these costs change in relation to the amount of miles you drive. No matter how far you drive your car, you will have the same fixed monthly car payment and insurance payment. Meanwhile, the gas and tires for your car are variable. This is because the more you drive your car, the more gas you will need and the more wear on your tires. This change in costs is your variable cost. Because you need both costs to operate and own a vehicle, you will have mixed costs. Now let's learn how to calculate mixed costs. The equation most often used for mixed cost is y equals a plus bx. Here y equals the total cost, a equals fixed cost, b equals variable cost, and x equals the number of units of activity. Let's return to Ryan's Stamp and Ink Company and apply the calculation. We start by inputting the amounts we have. The fixed cost, A, is the mortgage payment for the building, which is $500 per month. The variable cost, B, is the cost of boxes, which is $2 per box. The number of units of activity is the number of stamps produced, X, which we will say is 300. So our equation is y equals 500 plus 2 times 300. When we solve, we get y equals 1,100. So the mixed cost would be $1,100. There are multiple costs a business is faced with. Fixed costs are those costs that do not change in relation to production. Variable costs are those costs that change when production changes. Put them together and you get a mixed cost, which is a cost combining both fixed and variable costs. You can calculate mixed cost using the formula y equals a plus bx, where y equals total cost, a equals fixed cost, b equals variable cost, and x equals number of units of activity.
As you've probably gathered by now, companies treat variable costs, or those costs incurred for each unit of production, differently than fixed costs, or the costs of doing business that are more or less constant. In short, while fixed costs can be spread out, variable costs must be paid every period. Luckily, there is a statement that shows not only how much of total sales has been spent on variable costs, but also how much money is left after paying them. It also shows the total amount left after fixed costs are deducted. This statement is called the contribution margin income statement. In this lesson, we'll learn how to make one, why they are important, and what makes them different from a regular income statement. Making a contribution margin income statement is a very easy and straightforward process. First, we start with the total sales from the period. This is all the money that was made by the company from sales. From that, we subtract the variable production expenses. This includes everything from the cost of raw materials to the cost of electricity to run the machines. From this, we then subtract the variable labor expenses, which are those wages we had to pay for production. Someone working on a machine would count towards this, but an accountant wouldn't. The resulting number is the contribution margin. However, our form still isn't complete. From the contribution margin, we subtract any fixed costs, ranging from the cost of the land to salaries of managers. Finally, we subtract any other administrative costs. This is important to notice. The final number in the contribution margin income statement is not the contribution margin itself, as that occurs earlier in the document. Instead, it is the total profit. Obviously, if it is negative, it is a total loss. Here is an extremely basic overview of what this might look like. So why do we even bother writing this report? In short, it helps managers quickly figure out how much is being spent on variable costs. Companies always want to limit their costs, so if they see that more and more of their money is going towards variable costs, they may find a way to streamline operations. Likewise, if they see that they still have a large contribution margin but small profits, they may have to take a look at the fixed costs to determine if there is a more efficient system that could be bought to reduce costs across the board. This split of variable and fixed costs is what separates a contribution margin income statement from a regular or traditional income statement. A regular income statement simply clumps all business expenses together. After all, we are only really concerned about the bottom line with that statement. However, if we are using a contribution margin income statement, we have access to the breakdown between fixed and variable costs, and can therefore infer more about the operations of the product. In this lesson, we look at the contribution margin income statement, seeing that it splits up the expenses of a business into variable and fixed costs. It does this by showing the contribution margin, or the amount of money left after variable costs have been deducted from sales. In showing the breakdown like this, it differs from the regular income statement. Chances are that you didn't get into business just because you didn't have anything better to do. No, you wanted to make a profit. However, unless you happen to find a shrub that grows dollar bills, you know the old adage that money doesn't grow on trees. Instead, you have to spend money to make money, since raw materials have cost. And chances are, you're not interested in just making one of something. So when do you know when you've made enough of your products to make a profit? And how should you price your goods in order to make a desired profit? Luckily for you, there's something called a cost-volume-profit analysis for figuring this out. While this may sound intimidating, the concept is relatively straightforward. In fact, there's even a formula to help you completely understand how to use cost-volume-profit analysis. It's XP equals XV plus FC plus profit. But what does it all mean? The X stands for number of units sold. The P stands for price per unit sold. The V stands for variable cost per unit sold. FC stands for overall fixed costs. Finally, the profit is the amount of money that you want to make selling these goods. Remember that variable costs are costs that go up with each extra unit of production, like raw materials, while fixed costs are costs that are set and not dependent on production, like the property taxes on a factory. Let's walk through a quick example. Say that you wanted to make $100,000 by selling 10,000 widgets. The fixed cost is $200,000, while the variable cost per widget is $20. Let's plug those numbers into our formula. 10,000p equals 10,000 times $20 plus $200,000 plus $100,000. Simplifying it a bit, we get this. 10,000p equals $500,000. P equals $50. In other words, we have to sell each widget for $50 to make our desired profit. The contribution margin is the total revenue minus all variable costs. It realizes that fixed costs can be paid back over time. It's why the ice cream truck doesn't charge $50,000 for the first ice cream cone it ever sells. More often than not, the total contribution margin is the number used for income statements. Sometimes, instead of the total contribution margin, we may need to know the per unit contribution margin in order to figure out if we are reaching a point of diminishing returns. This would be useful in helping us make sure that our prices are high enough, for example. To find the price per unit contribution margin, we subtract the variable cost per unit from the price of the unit. For example, if a widget had a price of $50 and a variable cost per unit of $20, then the per unit contribution margin would be $30. Finally, we may sometimes want to know the contribution margin ratio, which gives us an idea of what portion of our total sales makes up the contribution margin. To do this, we divide the contribution margin by the total sales. For example, let's say we wanted to find the contribution margin ratio for the example in the previous section. First, we need to figure out the contribution margin. Remember, $500,000 was the total sales, 10,000 units times $50 per unit. So $500,000 total sales minus $200,000 variable costs would give us our contribution margin of $300,000. From there, we would divide this number by total sales, $300,000 divided by $500,000, giving us a contribution margin ratio of 0.6. A cost-volume profit analysis helps a company decide how many products it needs to make and at what price to sell them in order to make a desired profit. The formula for this analysis is XP equals XV plus FC plus profit. Remember that X stands for number of units, P stands for price per unit, V stands for variable cost per unit, and FC stands for fixed cost. Variable costs are those costs that increase with each additional unit made, while fixed costs stay the same no matter how many units are made. Finally, we learned how to calculate the contribution margin and the contribution margin ratio. The contribution margin is the total revenue minus total variable costs, while the contribution margin ratio is the contribution margin divided by total revenue.
Mr. U. Bright owns the Lamps for You company, which manufactures lighting products. He recently examined his manufacturing costs and wants to determine how the purchase of a new piece of equipment would impact his costs. Let's examine how Mr. U. Bright could complete this analysis. A company incurs different costs in order to manufacture its goods, and these costs can be classified as either variable costs or fixed costs. Variable costs are those costs that change with the amount of production activity. The amount of materials used and the amount of labor needed to manufacture items would be examples of variable costs. Fixed costs do not change with the level of production, such as the mortgage payment on Mr. U. Bright's production facility, which would be the same whether the company produced 10 or 10,000 lamps. A company's cost structure refers to the combination of variable and fixed costs that it incurs. The amount of profit that a company generates is affected by its costs and the volume of production. This relationship is known as cost-volume-profit analysis, or CVP. When a company is selecting its cost structure, it would consider its appetite for risk, as some structures will be more risky than others. Let's assume that Mr. U. Bright is trying to decide whether or not he should buy new equipment that incorporates the latest technology. This technology won't help him make the lamps any faster, but it will allow him to save money on direct labor, a variable cost, as fewer employees will be required on the production line. Even though Mr. Ubright's variable costs will decrease, his fixed costs will go up as more depreciation will be required on his new equipment. Depreciation, a fixed cost, represents the cost of using an asset, such as a piece of equipment, to earn revenue over its useful life. The analysis shows that sales revenue and operating income remain the same under both alternatives. Since the variable costs would be lower if the equipment is purchased due to lower direct labor costs, the contribution margin is higher. Contribution margin represents the amount of money that's left over after deducting variable costs that could contribute to covering fixed costs and generating a profit. Fixed costs will be higher if the equipment is purchased due to the increased depreciation. As part of this analysis, Mr. Ubright should calculate the contribution margin ratio, which represents the amount of sales that are available to cover fixed costs and contribute to profit expressed as a percentage. The formula for calculating the contribution margin ratio is contribution margin ratio equals sales minus variable cost divided by sales revenue times 100%. The contribution margin ratio relating to Mr. Ubright's decision would be buying the equipment will lead to lower variable costs and a higher contribution margin ratio, which means it will generate profit faster than the current situation, 70% versus 50%. Mr. Ubright would also need to calculate the break-even level for his products, which represents the number of units that must be sold in order to cover costs. The amount of profit earned at the break-even point is 0. The formula for calculating the break-even point in units is break-even point in units equals fixed costs divided by unit contribution margin. The formula for calculating the unit contribution margin is selling price per unit minus variable cost per unit. Let's assume that the unit contribution margin for the current situation is $25 and $35 if the equipment were to be purchased. The break-even point for Mr. Ubright's two scenarios would be the break-even point is greater in the scenario where Lamps for You purchases the new equipment, 2,857 units versus 2,000 units. This is due to the fact that buying the equipment has greater fixed costs, so it would have to produce more units in order to cover them. One of the factors that Mr. Ubright would consider when making the decision about whether to buy the equipment is the amount of risk he's comfortable assuming. A company with higher fixed costs and lower variable costs has higher operating leverage. Operating leverage refers to the extent to which a business has variable and fixed costs. A company with higher operating leverage is more risky as it must sell more units in order to break even. If Mr. Ubright were to invest in the new equipment, he would have to sell 857 more units, 2,857 minus 2,000, to cover his costs. However, for every unit he sells above the break-even point in the scenario where he buys the equipment, he would earn a higher contribution margin, 70% versus 50%. He also stands to lose more money if he fails to reach his break-even point, making the scenario in which the equipment is purchased more risky. When selecting a cost structure, management must consider variable costs. Variable costs, which change with the volume of activity, fixed costs, which remain the same regardless of activity, and the amount of profit it wants to earn. The relationship between costs and volume is known as cost-volume profit analysis, or CVP. Mr. Ubright would also calculate the contribution margin ratio, sales minus variable cost divided by sales revenue times 100%. A higher contribution margin ratio indicates lower variable costs, resulting in more money to cover fixed costs and earn profit. Another important calculation is the break-even point, fixed costs divided by unit contribution margin, which represents the number of units that must be sold in order to cover costs. The amount of profit earned at the break-even point is 0. Finally, a company must consider its appetite for risk as it selects its cost structure, as some will be more risky. A company that has high operating leverage is one that has lower variable costs and higher fixed costs.
Your son is saving for a new bike and decides to earn some extra money by mowing lawns in the neighborhood. He wants to know how many lawns he needs to mow in order to earn enough money to buy the bike. He must also figure out how much to charge each homeowner for this service, taking into account the cost of gas and his time to mow the lawn. Businesses face similar decisions when trying to determine if a particular product is making money for the company, and how much of that product should be produced given the business's finite resources. A business incurs a number of costs that are necessary for it to earn revenue, which is the same thing as income. For example, a business has to pay for electricity in order to operate. It needs to pay salaries to its employees, and it may need to pay rent. Costs can be classified as either fixed or variable. Fixed costs are constant and don't fluctuate with the amount of activity. An example of a fixed cost would be the monthly rent a business pays for its office space. Variable costs, on the other hand, vary with the amount of activity. An example of variable cost would be utility expenses, which vary with the amount of production. In the case of our lawn mowing entrepreneur, the amount of gas in the lawnmower would be a variable cost, since the more lawns he mows, the more gas he will use. In order to manage costs, businesses need to calculate the break-even point. This is the point where total costs equal total revenue. At this point, the business isn't either making money, profit, or losing money, loss. It is essentially just bringing in enough money to cover its costs. The break-even point can be expressed in terms of units or sales. The formula for calculating the break-even point in units is fixed costs divided by selling price per unit minus variable cost per unit. For example, let's assume that the MJ company incurs fixed costs of $450,000, has a variable cost for each unit of $25, and a selling price per unit of $40. The break-even point in units would be 30,000 because 30,000 equals $450,000 divided by $40 minus $25. This means that the MJ company must sell 30,000 units of its product in order to cover its costs. Remember, the MJ company is not generating any profit at this production level, but if it were able to produce more than 30,000 units of this product, it would generate a profit. This type of analysis can help a company determine if it's worthwhile to continue producing a product, or whether it would be better off ceasing production. The break-even point can also be calculated in terms of sales dollars. The formula for calculating the break-even point in sales is fixed costs divided by contribution margin ratio. The contribution margin is the difference between the selling price of a product and its variable cost. The formula to calculate the contribution margin ratio is contribution margin divided by selling price of the product. Let's use the same data for the MJ company, where the fixed costs are $450,000, the variable cost of each unit is $25, and the selling price per unit is $40. The contribution margin per unit is $15, or $40 minus $25, so the contribution margin ratio would be 0.375, $15 divided by $40. To turn that into a percentage, so you can use it in your break-even point formula, just multiply that by 100, which equals 0.375 times 100, which equals 37.5%. Now we can determine that MJ Company's break-even point in sales is 1,200,000, which is equal to 450,000 divided by 37.5%. This means that the company must generate sales of at least $1,200,000 in order to cover its costs. Any sales above $1,200,000 would result in the MJ Company earning a profit. In addition to determining the minimum number of units that must be produced to cover costs, businesses also calculate profit targets, which are just goals for how much money a company hopes to make. These can be expressed in terms of number of units or sales dollars. Let's assume that the MJ Company has a target profit of $600,000, fixed costs of $450,000, and a contribution margin per unit of $15. The formula for determining the sales in units to achieve this profit would be fixed costs plus target profit divided by the contribution margin per unit. In order to reach its profit target of $600,000, MJ Company would have to sell 70,000 units equals $450,000 plus $600,000 divided by $15. The formula for calculating the target profit in terms of sales dollars is fixed costs plus target profit divided by contribution margin ratio. Using the MJ Company's contribution margin ratio of 37.5%, which we just found, its profit target in terms of sales dollars would be $2,800,000, $450,000 plus $600,000 divided by 37.5%. This result shows that the MJ Company must sell $2,800,000 of products in order to reach its target profit of $600,000. This type of analysis helps a business determine whether its target profit is achievable given its current production capabilities. The margin of safety shows the difference between the break-even point and anticipated levels of production, expressed as a percentage. The lower the margin of safety, the greater the risk, because production levels do not have to fall very far before the break-even level is reached. The formula for calculating the margin of safety is anticipated sales minus break-even sales divided by anticipated sales. Let's assume that the anticipated production for MJ Company is 37,000 units, and the break-even point is 25,000 units. The margin of safety would be 32%, 37,000 minus 25,000 divided by 37,000. Let's review what we've learned. First, you should remember 4 of the basic factors that go into analyzing and calculating profits. Revenue, which is the same thing as income. Fixed costs, which are constant and don't fluctuate with the amount of activity. And variable costs, which vary with the amount of activity. Most crucially, the break-even point is the point where total costs equal total revenue. But how is this calculated or analyzed? The formula for calculating the break-even point in units is fixed costs divided by selling price per unit minus variable cost per unit. We also learned that the break-even point can also be calculated in terms of sales dollars, the formula for which is fixed costs divided by contribution margin ratio. The contribution margin is the difference between the selling price of a product and its variable cost. The formula to calculate the contribution margin ratio is contribution margin divided by selling price of the product. We also figured out how to calculate profit targets, which are simply the goals for how much money a company hopes to make. The formula for determining the sales in units to achieve a certain profit is fixed costs plus target profit divided by the contribution margin per unit. You also have to consider the margin of safety, which shows the difference between the break-even point and anticipated levels of production, expressed as a percentage, and has the formula of anticipated sales minus break-even sales divided by anticipated sales.
Mr. Sweet owns the Sweets R Us company, which manufactures and distributes candy. His company is profitable, but he wonders if all the costs of manufacturing the products are captured and reported accurately. At a recent industry conference, one of his competitors was talking about financial information prepared using absorption costing and internal information prepared using marginal or variable costing. Mr. Sweet would like to learn more about these 2 types of costing systems and which one he can use for external versus internal reporting. Manufacturing a product involves direct materials, direct labor, and variable and fixed manufacturing overhead. Direct materials represent the cost of materials used directly in the manufacturing process. Direct labor reflects the wages of those employees who manufactured the product. Variable manufacturing overhead varies with the volume of production, and an example would be utilities. Fixed manufacturing overhead include costs that remain the same regardless of how many units are produced, such as the rent that Mr. Sweet pays in his production facility. It's simple to trace direct materials, direct labor, and variable manufacturing overhead costs to a particular product. In absorption costing, fixed manufacturing overhead costs are also allocated to each unit that's produced. As a result, each finished product absorbs all the costs related to its manufacture. Fixed overhead is allocated to each unit produced using the formula fixed overhead rate equals estimated fixed overhead costs for the period divided by estimated activity for the period. Let's assume that Sweets R Us estimates its fixed manufacturing overhead costs to be $5,000 for the month, and it estimates it'll produce 2,500 units of product. The fixed manufacturing overhead rate for this period would be $2 per unit, which is found by dividing the estimated fixed overhead costs by the estimated activity for the period, or $5,000 divided by 2,500 equals $2. In absorption costing, fixed manufacturing overhead is allocated to the finished product and becomes part of the cost of inventory. Inventory represents items where manufacturing is complete, but they haven't been sold to the consumer. Due to the treatment of fixed manufacturing overhead, a higher net income is reported on the income statement, which summarizes revenue and expenses for a particular period. Accounting standards require that absorption costing be used since the cost of inventory must include all purchasing, conversion, and any other costs to get the inventory ready for sale. This includes direct materials, direct labor, and both variable and fixed manufacturing overhead costs. As an example, let's assume the following information for the Sweets R Us company. The sales for the period equal $250,000. The opening inventory is at $0. The manufacturing costs include direct materials at $80,000, direct labor at $60,000, variable overhead costs at $10,000, and fixed overhead costs at $20,000. The ending inventory includes 3,000 units, which equals $51,000. And the selling and administrative expenses equal $60,000. Absorption costing includes all manufacturing overhead, both variable and fixed, and is calculated using the cost of goods sold formula. The cost of goods sold formula is cost of goods sold equals opening inventory plus direct materials plus direct labor plus variable manufacturing overhead plus fixed manufacturing overhead minus ending inventory. Using the information from the Sweets R Us company, we'd get $119,000, or 0 plus 80,000 plus 60,000 plus 10,000 plus 20,000 minus 51,000. The income statement using absorption costing would look like this. Fixed manufacturing overhead is allocated to the units included in finished goods or ending inventory, and its costs will be carried over to the next period until the finished product is sold to consumers. In marginal costing, the cost of a finished product includes direct materials, direct labor, and variable manufacturing overhead. Fixed manufacturing overhead is an expense in the period in which it occurs and doesn't become part of the finished goods inventory. For example, let's assume the same information for the Sweets R Us company as before, only now with the ending inventory of 3,000 units equaling 45,000, as fixed manufacturing overhead isn't included. The formula to calculate cost of goods sold under marginal costing is cost of goods sold equals opening inventory plus direct materials plus direct labor plus variable manufacturing overhead minus ending inventory. When this is applied to the Sweets R Us company information, it comes to $105,000, or 0 plus 80,000 plus 60,000 plus 10,000 minus 45,000. Note how this is lower than the 119,000 reported under absorption costing. The difference is due to the inclusion of fixed manufacturing overhead in absorption costing. The income statement will also look differently because fixed manufacturing overhead will be reported as an expense. It would look like this. Note that net income before tax is $6,000 lower using marginal costing. The difference is because fixed manufacturing costs are included in the ending inventory of $51,000 and carried over to the next period when the goods are sold in absorption costing, but they're not included in the ending inventory of $45,000 in marginal costing because they're expensed in the period in which they were incurred. Also note that the contribution margin is calculated instead of a gross margin, since cost of goods sold contains only variable expenses. Direct materials, direct labor, and overhead costs are incurred to manufacture a product. While it is straightforward to trace direct materials, direct labor, and variable manufacturing overhead costs to a product, it's difficult to trace fixed manufacturing overhead costs to a particular product. In absorption costing, inventory cost includes direct materials, direct labor, and variable and fixed manufacturing overhead costs. Marginal costing doesn't include fixed manufacturing overhead in its calculation of inventory, but expenses it in the period in which it's incurred. Accounting standards specify that all costs to manufacture a product must be included in its inventory cost and therefore absorption costing is used for external reporting and tax purposes.
Isabella So is the owner of the Wedding Shop, a store that designs and manufactures custom-made wedding dresses. Each dress is unique and requires different amounts and types of materials and trimmings. Isabella's business is profitable, but she would like a more formal way to keep track of the amount of material she is using, so she knows how much to order. She also wants to get a better idea as to how much time her seamstresses are spending on sewing and finishing the orders. In a job order costing system, the following costs must be tracked separately: direct materials, direct labor, manufacturing overhead. Manufacturing overhead represents an allocation of costs to each manufactured item for expenses that are not project-specific. For example, Isabella must pay monthly rent and utilities on her production facility. She allocates a portion of the total cost incurred for these items to each project that is worked on during a particular period of time. When Isabella meets with a bride and finalizes the dress design, she must determine the amount and nature of materials that are required to complete the project. Once this has been determined, one of Isabella's seamstresses receives the order and completes a materials requisition form. The materials requisition form provides the following information: quantity and description of materials needed, item number of materials required, cost per unit, total cost, cost per unit times quantity, customer name and job number, the name of the individual who completed the requisition, and the name of the employee who approved the costing for the order. Let's assume that Isabella meets with a customer, Mary Bell, to finalize the design for Mary's dress. Isabella must then meet with her seamstress, Miss B. White, to discuss the details. Miss White completes a materials requisition form and provides it to Miss I. Count to be costed. Let's examine the materials requisition form for Mary's dress. We can see that 4 different items are needed to construct the dress, and the total cost of these items, or raw materials, is $420. Since Miss White, Isabella's seamstress, works on a number of projects every day, she must track how many hours she spends on each project. This tracking is captured on a time ticket or an employee time ticket and can be maintained manually or on a computerized system. The time ticket contains the following information: name of employee, employee number, job number, date, start and stop times of hours worked, total number of hours worked, hourly rate, total cost, supervisor approval. Miss White's time ticket for May 4th would appear as follows. We can see that Miss White worked on Mary's dress for 6 hours on May 4th, and her hourly rate is $15. The ticket also shows us that Isabella has approved the number of hours for this day. If we were to examine all the time tickets from Miss White's work on Mary's dress, we would see that she worked a total of 14 hours between May 4th and May 25th at a total cost of $210. Isabella incurs costs on a monthly basis that cannot be traced to specific jobs. Examples of these costs would include rent, utilities, and salaries of employees in the accounting and marketing departments. Even though costs cannot be traced to specific projects, costs are accumulated and allocated to each project based on an estimate of the total factory or production costs that a business expects it will incur. Based on past experience, Isabella may estimate that she will incur overhead costs of $2,400 for the month, and her employees will work a total of 480 hours. The formula for calculating manufacturing overhead is manufacturing overhead equals total factory overhead costs, estimated, divided by estimated basis for allocating costs. Isabella has chosen direct labor as the basis for allocating her overhead costs. Therefore, the overhead rate that would be applied to each project completed during the month would be manufacturing overhead equals $2,400 divided by 480 hours equals $5 per hour. Since Miss White worked on Mary's dress for 14 hours during the month, $70, $5 per hour times 14 hours of overhead would be applied to this project. Once the materials, labor, and overhead costs have been determined, the total cost of the project is summarized on a job cost sheet, which Isabella uses to analyze how much profit was made on the project and to confirm that the project was costed properly. Since the job cost sheet is completed at the end of the project, Isabella could use the information to inform future projects if the analysis showed that changes to the quoting process needed to occur. The job cost sheet for Mary's dress, job number 1633, would show the following information. Isabella can easily see from the job cost sheet that $700 in costs were incurred to make Mary's wedding dress. If Isabella charged Mary $1,800 for the dress, then she would have made a profit of $1,100, $1,800 minus $700. In a job order costing system, each item that's manufactured is unique, and costs can be identified and traced separately. As the item moves through production, the costs are identified on the materials requisition sheet for materials used, the time ticket for employee hours worked on the project, and all costs, including an allocation of manufacturing overhead, are summarized on the job cost sheet, which allows management to determine if the pricing for a particular job was appropriate, or whether the pricing for future jobs of a similar type need to be changed.
Katie's Cookies produces a variety of cookies using healthy ingredients. While the owner, Ms. Sweet, is very familiar with the production process, she would like to better understand how costs are accumulated along the way as she considers increasing her selling prices. To better understand this, let's look more closely at the manufacturing process. A manufacturing company converts raw materials into finished goods that are sold to consumers. Raw materials are unprocessed items that have not started the conversion process. For Katie's Cookies, examples of raw materials include flour, sugar, butter, and eggs. An intermediate step between raw materials and finished goods is work in process. The work in process step involves goods that have started the conversion process but must still undergo additional steps before they are ready to sell to the consumer. Cookie dough that has been mixed but not yet baked would be an example of work in process goods for Katie's Cookies. And as you may have guessed, the finished goods are those items that are completed and are ready to sell to the consumer. In Katie's Cookies case, those are the cookies. Yum. Costs are accumulated at every step of the conversion process and must be taken into consideration when calculating the final cost of the finished good. In order to determine a selling price that will cover the cost of manufacturing an item and generate profit, a business must identify all the costs associated with producing a particular item. Let's look at the process of accumulating costs for a batch of Katie's famous oatmeal raisin cookies. We begin by moving them through the raw materials to work and process steps. At the start of the process, Ms. Sweet must purchase all the raw materials necessary to produce a batch of cookies. For example, she would need to purchase butter, eggs, flour, sugar, baking powder, oatmeal, and raisins. These items would be accumulated in an account called raw materials inventory. As items are needed in the production process, the costs of the quantities used would be moved from the raw materials inventory account to the work in process inventory account. For Katie's Cookies, activities in work in process would include measuring the ingredients necessary to make a batch of oatmeal raisin cookies. Since the cookie batter will not mix itself, direct labor costs must be added to the work in process stage of conversion, along with overhead costs. Direct labor costs added at this stage represent the wages of those individuals who are directly involved in the conversion process. Examples of direct labor include the employees responsible for measuring the ingredients, mixing the cookie dough, and putting it into the oven to bake. Overhead costs are those costs that the business incurs to manufacture its product that are not directly related to the product. For example, Katie's Cookies would have to pay rent and utilities on its manufacturing facility, as well as salaries for office staff that work in sales, marketing, and accounting. Now, we move from the work in process to finished goods step. Once the cookies have been baked, checked for quality, and packaged, Katie's Cookies would transfer the costs from work in process inventory to finished goods inventory, indicating that the conversion process is complete and the cookies are ready to sell to consumers. When an item has been moved to finished goods inventory, it includes all the costs to produce it, such as raw materials, direct labor, and overhead. Decisions about what to charge the consumer for the product can be made now, since all cost information is complete. When the item is sold to a consumer, the finished goods inventory is decreased and the cost of goods sold account increases. The cost of goods sold account represents an expense that the company incurs in producing the item, and it is subtracted from the revenue, the earnings from selling the product, to determine if the company made profit or not, and if so, how much it made. So this equation is revenue minus cost of goods equals profit. Let's assume that Katie's Cookies purchased $10,000 in raw materials in the month of June. As you can see on this cost of flow table, $7,500 of those raw materials was transferred to work in process, where $2,000 of direct labor and $1,500 of overhead was applied. At the end of the month, $9,000 of goods was completed and transferred from work in process to finished goods. In addition, finished goods totaling $2,000 remained, and $7,000 of cookies was sold to consumers. In a manufacturing company, raw materials, or unprocessed items that have not started the conversion process, are purchased and moved into the production process, where additional costs for direct labor and overhead are applied. When production is complete, the goods are moved from work in process inventory, which includes goods that have started the conversion process but must still undergo additional steps before they are ready to sell to the consumer. From there, they are moved to the finished goods inventory, which consists of the final products ready to be sold to the consumer. When goods are sold to the consumer, they are removed from finished goods inventory and recorded as cost of goods sold.
The Super Scoop Company manufactures ice cream that is sold in grocery stores. The owner of the company, Mr. Scoop, is trying to gain an understanding of the different components of his company's inventory and how it is reported on the financial statements. Inventory in a manufacturing company consists of raw materials, work in process, also referred to as WIP, and finished goods that will be sold to consumers. Raw materials are unprocessed goods that the company uses at the start of its manufacturing process. For the Super Scoop Company, raw materials could include things like sugar and milk. Work in process, or WIP, includes goods that have started the conversion process from raw materials to finished goods but aren't yet complete. For example, the Super Scoop Company could have pasteurized its base product but may not have added the flavoring to finish making the chocolate ice cream batch yet. Finished goods include items that have completed the conversion process and are ready to sell to the consumer. Ice cream packaged in cartons and ready to ship to grocery stores are examples of finished goods for the Super Scoop Company. In order to value its inventory, a company must keep track of all the costs of its inventory at each stage of the process. For example, the Super Scoop Company would want to keep track of the costs of milk and sugar, its direct labor costs, including the cost of its hourly employees, and its manufacturing overhead, which would include rent, utilities, salaries of plant supervisors, and depreciation. Depreciation is the process of allocating the cost of an operating asset, such as a machine or piece of equipment, over its useful life as it is used in the manufacturing process to create sales for the company. Financial statements summarize the financial position of a company. Types of financial statements include the income statement and the balance sheet. The income statement summarizes the sales revenue that the company earned by selling its product to customers and the expenses it incurred in order to make those sales. It also illustrates the company's net income, revenues greater than expenses, or net loss, expenses greater than revenue. The balance sheet shows the assets, liabilities, and equity of a company. Assets represent items that a company owns, like inventory. Liabilities represent what the company owes to others, and equity represents the owner's investment in the company plus any earnings of the company over time. Inventory will impact both the income statement and the balance sheet. The amount of inventory a company has at the end of the period will be reported on the balance sheet as inventory and should include raw materials, work in process, and finished goods inventory. The cost of inventory is recorded on the income statement as cost of goods sold. The formula for calculating cost of goods sold for a manufacturing company is beginning finished goods inventory plus cost of goods manufactured equals cost of goods sold minus ending finished goods inventory. This calculation is summarized on the cost of goods sold statement, and total cost of goods sold is then reported on the company's income statement. In order to track its cost and calculate cost of goods sold for the period, companies must prepare a cost of goods manufactured statement. This statement considers the raw materials and work in process inventory balances, as well as direct labor and overhead costs. In order to prepare this statement for the Super Scoop Company, we need information about its beginning and ending inventory balances, its purchases, and the amount of labor and overhead used to make ice cream throughout the year. Let's assume that the Super Scoop Company has the following inventory balances at the beginning of the year. Raw materials inventory equals $120,000. Work in process inventory equals $95,000, and finished goods inventory equals $110,000. At the end of the year, the balances were raw materials inventory equals $100,000, work in process inventory equals $75,000, and finished goods inventory equals $90,000. During the year, the company purchased $140,000 in raw materials. Direct labor used in the manufacturing process was $250,000, and total overhead was $130,000. Total overhead consisted of rent at $50,000, depreciation at $20,000, utilities at $25,000, and salaries of indirect labor $35,000. The cost of goods manufactured would be $560,000. Notice that the finished goods inventory does not appear on the cost of goods manufactured statement. The finished goods inventory is needed for the cost of goods sold calculation and not the cost of goods manufactured. The cost of goods sold for the Super Scoop Company is $580,000. Now that the Super Scoop Company has calculated its cost of goods sold, it can take this amount to its income statement to determine its profit or loss for the period. Let's remember that manufacturing overhead only includes expense items associated with producing its ice cream products. There are other expenses that aren't production costs, like sales reps, headquarters administrators, and executive salaries. We call the expenses not attached to products as manufacturing overhead selling, general and administrative expenses. Let's assume that total sales for the period equals $950,000, cost of goods sold equals $580,000, rent equals $50,000, selling, general, and administrative expense equals $130,000. The amount of Super Scoop's net income before taxes would be $240,000, and the income statement would look something like this. All ending inventory, including balances in raw materials, work in process, and finished goods, would be reported as a current asset on Super Scoop's balance sheet. In practice, all three categories would be totaled and reported as one figure. The breakdown of the balance into its three components would be disclosed in the company's notes to the financial statements so the reader would be able to easily identify each component. The Super Scoop Company's total inventory reported on the balance sheet would be $265,000, raw materials of $100,000, plus work in process inventory of $75,000, plus finished goods inventory of $90,000. The inventory of a manufacturer is the sum of the raw materials, work in process or WIP, and finished goods. It must be tracked and is used to calculate the company's cost of goods sold, which is used in the determination of a company's net income. Have you ever been to a Shoppers Club warehouse? If so, then you know how amazing it is to walk into this big building full of all sorts of items. I love going and buying things in bulk, and I'm always amazed at how much inventory there is stocked up on the shelves. I've never really thought about how much that inventory has to cost the company. In my mind, if they bought it wholesale, then the price of the inventory is the actual purchase price that was paid for the item. However, my way of thinking is incorrect. You see, in all actuality, inventory costs are not only the price that was paid to purchase an item, but also the cost of storing and maintaining that item for however long it takes it to sell. Inventory costs can be broken down into three categories: ordering costs, carrying costs, and shortage costs. These are the only costs that will appear on the financial statements. The following costs are useful information for management, but they're not inventory costs per GAAP. When I think about my trips to my local Shoppers Club warehouse and why I love going, it really is because of the variety of products that they have. You know, somebody had to order all this stuff. Somebody had to deliver the products, and somebody had to receive the products and then put them on the shelves. Did you know that all these things are part of ordering costs? Ordering costs are the costs that are incurred to prepare and process purchase orders and to receive and inspect merchandise that has been ordered. The pay that is received by the people that order inventory, deliver inventory, and receive and stock inventory is considered an ordering cost. If purchase orders are written up or printed, the cost of the purchase orders is also considered an ordering cost. The next component of inventory costs are carrying costs. Carrying costs are the costs that are related to keeping inventory in stock. Do you think that inventory purchased is paid for by money that the company has in its bank account? Maybe some of it, but a part of the money used to purchase inventory comes from financing activities, whether it be bank financing or investor-centered financing. Both types of financing results in interest fees. These interest fees are part of carrying costs. I mentioned previously how I was amazed at the amount of inventory items that were stored in visible areas of the warehouse. I can't even imagine how much was stored that I couldn't see. Regardless of where it is stored, the expenses of storing the inventory and keeping it in good condition are all considered storage space costs. These include the electricity that is needed to provide lights, air, and heat for the warehouse. They also include any building rent that is paid on the warehouse and business locations, the purchase cost if a building is purchased, and the real estate taxes associated with each. Storage space costs are also part of carrying costs. Another important part of carrying costs comes in the form of risks that are made by a company when inventory purchases are made. What if all the inventory doesn't sell? What if competitors lower their prices on the same item? What if inventory is stolen or damaged? These are all risks that have a monetary value to them. For instance, say I walked into the store and saw that they had grapes on sale for $1.69 a pound. When I go to look in the bin and get a nice bundle, I see that there are also containers of grapes that are discounted to $1 a pound. These are grapes that are older than and not as pretty as the more expensive ones. If any of those grapes sell, then the company loses 69 cents a pound on them. If they don't sell, then the company loses all the money that they spent purchasing the grapes as inventory. That risk of losing money on inventory is also part of carrying costs. The third component of inventory costs is shortage costs. Shortage costs are the costs that a business incurs when they run out of stock. For example, let's say that the local Shoppers Club warehouse advertises a specific brand of television for a really good price. The person in charge of ordering forgets that these televisions will be going on sale and only orders 5. When the sale starts, the televisions sell out within a few hours. More have to be ordered and need to be shipped as quickly as possible. The quick shipping comes at an expensive price. That added cost is an example of a shortage cost. Another prime example of a shortage cost is having to pay a higher wholesale cost on an item to quickly replenish inventory. Now, here's a question that I bet you're asking yourself. Why is inventory cost so important? At the end of the day, the one thing that business owners want to know more than anything is how much money the business is making. If it's not making as much as it should, then there needs to be adjustments made. In order to figure how much money is being made from sales, then you have to know 2 things. Number 1, you have to know the total dollar amount of sales for the period. Number 2, you have to know how much the items that were sold cost. The cost of goods sold, also known as COGS, is the total dollar amount, including inventory costs, that a business paid for items sold. Once you know these 2 numbers, then you simply subtract the cost of goods sold from sales to get profit or loss from sales. Let's look at an example of this. I paid $599 for a 52-inch television. The wholesale cost of the television was $330. It cost $29 for shipping and a total of $47 for warehousing costs. The total cost of goods sold was $406. The profit from the sale of the television was $599 minus $406, which equals $193. Notice that the cost of goods sold amount was more than the wholesale cost. That is because we had to include everything that is part of the inventory cost. When I go shopping, I never think about all the little pieces that make up the price of the items that I buy. It's amazing to realize just how much is involved in the cost of inventory. Inventory cost is not only the price that was paid to purchase an item, but also the cost of storing and maintaining that item for however long it takes to sell. It can be broken down into 3 categories: ordering costs, carrying costs, and shortage costs. Ordering costs are the costs that are incurred to prepare and process purchase orders and to receive and inspect merchandise that has been ordered. Carrying costs are the costs that are related to keeping inventory in stock. Shortage costs are the costs that a business incurs when they run out of stock. Knowing inventory costs is an essential part of knowing the total cost of goods sold. The cost of goods sold is the total dollar amount, including inventory costs, that a business paid for items sold. In order for a business to calculate how much money that it actually made from sales, the cost of goods sold is subtracted from the total sales to get the bottom line proceeds made from the sale of goods.
Miss Hare owns the Mind the Cap company, which manufactures high-end hats.
While she understands the materials and labor needed to produce her hat, she doesn't have a good understanding of how manufacturing overhead is allocated to her products, and how the allocation may impact her company's profit. Let's learn with her. As a product is manufactured, it goes through a number of processes on its way to becoming a finished good that is ready to be sold to a consumer. Manufacturing a product requires direct materials, direct labor, and manufacturing overhead. Direct material costs consist of the raw materials that are used to create the product. Examples for mind the cap would include cloth and sewing thread. Direct labor costs include salaries of those employees directly involved in manufacturing, like employees in the cutting and sewing departments. Manufacturing overhead is an accumulation of costs that cannot be traced directly to an individual product and include costs such as rent on the company's production facility and depreciation, or the costs associated with using an asset over a period of time, on company equipment. Since manufacturing overhead costs are not known until after the product is manufactured, companies calculate a predetermined overhead rate, an estimate of manufacturing costs based on the company's past performance or history. The formula for calculating the predetermined overhead rate is estimated manufacturing overhead divided by estimated total units in allocation base. The allocation base can be direct labor hours, direct labor dollars, or the number of machine hours. The determination of which base to use largely depends on whether manufacturing the product requires more labor or the use of machines. Let's assume that Mind the Cap uses direct labor hours as its allocation base, and it estimates that its annual manufacturing overhead will be $50,000 and direct labor hours will be $25,000 for the current year. Its predetermined overhead rate would be $2 per hat, or $50,000 divided by $25,000. Since the predetermined overhead rate is calculated using estimates at the beginning of the year, the cost will differ from the actual manufacturing overhead costs incurred. As a product is manufactured, manufacturing overhead costs are charged to the manufacturing overhead account using the predetermined overhead rate. As actual costs become known, they are also charged to the manufacturing overhead account. At the end of the year, the balance in the manufacturing overhead account is reviewed and must be cleared out. If the overhead allocation using the predetermined rate is greater than the actual manufacturing overhead, then overhead has been over-applied. In other words, if the guess was more than the reality. If the actual manufacturing overhead is greater than the overhead allocated using the predetermined rate, the manufacturing overhead has been under-applied. In other words, if the guess was less than the reality. Mind the Cap applied manufacturing overhead of $225,000 during the year, based on its predetermined rate, but the actual manufacturing overhead based on the products manufactured was $250,000. In this case, Mind the Cap has underapplied its manufacturing overhead by $25,000, or $250,000 minus $225,000, and an adjustment is required to dispose of the difference. At the end of the company's accounting period, the manufacturing overhead account must be cleared out by distributing the balance to work in process, finished goods, and cost of goods sold accounts, or by distributing the entire balance to the cost of goods sold account. Work in process represents goods which have started the conversion process from raw materials but required further work before they are ready to sell to the final consumer. Finished goods represent products that are ready to sell to the consumer. Cost of goods sold represents all the costs of manufacturing the products that were sold to consumers. Mind the Cap could choose to allocate the $25,000 balance in manufacturing overhead to all three categories. This approach is more accurate, but it is also more time-consuming, as you have to figure out how much to apply to each one. Another method of clearing the manufacturing overhead account is to transfer the entire underapplied amount to cost of goods sold directly. This method is not as accurate as the first method, but it is much simpler. Manufacturing a product requires direct materials, direct labor, and manufacturing overhead. Since actual manufacturing overhead costs are not known until the end of the accounting period, companies calculate an estimate, or predetermined overhead rate, and apply it to all the products that are manufactured during the year. The formula for doing so is estimated manufacturing overhead divided by estimated total units in allocation base.
The actual cost will differ from the estimate, so an adjustment is required at the end of the year to clear out the manufacturing overhead account. If actual manufacturing costs are greater than the manufacturing overhead that was applied using the predetermined overhead rate, then overhead costs were underapplied. If less, then they were overapplied. You have to clear out the manufacturing overhead account at the end of the year. The difference can be allocated to all three of the following: work in process, or goods not finished yet, finished goods, or goods ready to sell, and cost of goods sold, or all the costs of manufacturing the products that were sold. Or the entire account can be cleared to cost of goods sold directly, which is less complicated but also less accurate.
Joey just moved to town. He recently left a company that manufactured automotive parts where he worked in their accounting department, but with the change in scenery, Joey decided to seek somewhere new to work where he wasn't familiar with the company or products. He was excited and a little nervous. Finally, the day came for an interview with a local advertising firm. It piqued his interest to see how different this job would be compared to his last one. The interviewer was impressed with his background. Finally, the big question that Joey was worried to hear. "So you used to work at a manufacturing company and now want to work for us? We're a service company. Do you think that your skills and knowledge will be a good fit here?" Fast forward 2 weeks. Joey was offered the job and is set to begin today. Right off, he's given a copy of the financial statements and other financial books and can see that there are some clear differences in how they do things here at this advertising company. Oh well, he thinks, here goes nothing. Because Joey's new employer is an advertising firm, they're classified as a service company. A service is work performed for a customer. Examples of service companies include attorneys or advertising firms. They do not manufacture and sell products, but rather sell services that they perform for their customers. Service companies can use various types of costing systems to determine their costs and how to charge customers. The most used costing system in service companies is the job order costing system. This system assigns cost to a specific unit or product. In this case, it assigns cost to a specific service. Joey is not very familiar with this costing system since his old employer used process costing, which was more useful to them because they made mass quantities of their products instead of specific units or products. Luckily, he quickly learns that the job order costing method is not very different from what he's used to, but there are some new terms for the accounts names that he has to learn. These terms are very similar to those used in a manufacturing company, but are changed slightly to reflect the fact that the firm is a service company. A manufacturing company uses the term raw materials inventory, but since service companies don't use raw materials, they use the term parts inventory, or just simply supplies. Similarly, a manufacturing company considers its work-in-progress inventory compared to a service company's service contracts in process. There's no substitute for finished goods, but costs of goods sold turns into costs of completed service contracts. And finally, rather than manufacturing overhead, a service company has service overhead costs to consider. The service company account names reflect the service contract that the company enters into with customers. There's no product being sold. Let's look at an example. If you need to pause the video in order to take a closer look at the journal entries, please do, and then resume whenever you're ready. We're Hot Inc. is the advertising company at which Joey now works. They recently signed a service contract with a local company to create, produce, and publish a 30-second advertisement for television. This advertisement will focus on the local company's newest product. We're Hot begins the contract with $50,000 cash in the bank. They must purchase a new camera to shoot the advertisement, which will cost them $5,000. This is the first cost to be incurred by the company on this contract. They begin the work on the contract in December of 2015 and expect to finish in the first quarter of 2016. This chart illustrates the journal entry for the purchase of the camera. The labor that is required to work on the service contract in December of 2015 will look a little something like this. We're Hot calculates the overhead attributable to service contract number 33 for December 2015 and records it like this.
Now that 2015 has ended, all of the costs assigned to service contract number 33 from December of 2015 are recognized as part of the account called Service Contract in Progress. These costs are put in this account because the end of 2015 signals the end of an accounting time period. 2016 will begin a new time period. This chart illustrates the entry to the account Service Contract in Progress. We're Hot and the customer have also agreed to progress billings to cut the amount owed by the customer into pieces. Contract 33 is completed in January of 2016. There were no additional parts or materials purchased. These two charts illustrate the entries for labor and overhead for January 2016 for Contract 33. And the final bill will look like this. When the cash is received, they will have $20,000 in revenue, $9,500 plus $10,500 to offset the $13,100 in costs, $9,500 plus $3,600, leaving a $6,900 profit. Service companies assign cost to services in a similar way that manufacturing companies assign cost to products, but use some different terms to name accounts. They assign costs to their services and record them through the job order costing system in journals in a method that's also similar to manufacturing companies. It's important to differentiate the two types of companies, manufacturing and service, and identify the specific account names associated with each.
Companies rarely finish one unit of production before they start another, and they don't just work to a certain point and then go home for the rest of the month. Instead, companies are always working on production, and there are units of production that may or may not be complete when the time comes for a company to perform its accounting. So what is a company to do? Does it just ignore the incomplete units? In that case, there would be a problem. It would look like some months were especially productive for the company when there were actually just lots of units that were half done from the month prior, and some months that look, well, wasted in comparison. Needless to say, neither would be fun for a manager to have to explain time and time again. Luckily, there is a solution. By using the weighted average method of equivalent units of production, managers can include units that have already entered production in their activity reports. In other words, they can more easily show just how much work was actually done. Finding the number of equivalent units by using the weighted average method of production is pretty straightforward. First of all, take the number of units that are still in production at the end of a period, then multiply that number by the percentage that those units are from being complete. In cases where units are at different points of completion, simply use the average progress of those units. This gives you the number of equivalent units. This process is known as conversion. As you see it, it is effectively a measure of how many units you could have completed had you focused solely on finished units and not on continuous production. Let's use an example to see how this works. Let's say that you managed a widget manufacturing company. In a given month, you completed 10,000 widgets, but you still have 2,000 widgets under production. Remember, when it comes time to fill out any paperwork, like the cost reconciliation report that justifies your expenses, that those 10,000 completed widgets are considered goods transferred out because they have moved on to a different department. Anyway, back to those partial widgets. While each widget is at a different stage of completion, on average, they are 50% done. To find the equivalent units, we multiply 50% by 2,000 widgets still under production. In doing so, we get 1,000 equivalent units of widgets. But how do we use this number? Surely we can't sell half widgets now, can we? No, unfortunately we can't. However, it can make our accounting paperwork make much more sense. Remember that I said that the cost reconciliation report uses those 10,000 widgets as goods transferred out? What I didn't mention yet is that it also asks for the cost of inventory of equivalent goods. After all, that is considered an asset. To find the cost of inventory of equivalent goods, multiply the cost of a finished unit by the number of equivalent goods. Note that these costs especially include the cost of labor and overhead. In this lesson, we learned how to use the weighted average method of equivalent goods to help us reconcile the realities of production to accounting paperwork. Remember that the way to find the number of equivalent goods is to multiply the number of units still under production by their percentage towards completion. This process is called conversion. Also bear in mind that completed goods are goods transferred out, and that both these and equivalent goods have a role to play on the cost reconciliation report that justifies expenses.
Miss Yu Cook is the owner of the bake shop. She uses her grandmother's recipes to produce the best cakes and cookies in town. Although she has the list and quantity of ingredients that go into her famous recipes, she's not sure how to calculate the cost of the products she bakes and sells to her customers. Unlike a merchandising company, which buys and sells inventory, a manufacturing company produces or makes its products. As a result, a manufacturing company has 3 different types of inventory, namely raw materials, work in process, and finished goods. Raw materials represent unprocessed goods that go through some type of conversion to become a sellable product. In the case of the bakery, a raw material could be the flour or sugar that's used to make a chocolate cake. Work in process, or WIP, represents items that have started the conversion process from raw material to finished good, but are not yet complete. For example, the bake shop can have baked a cake but has yet to put icing on it. Finished goods represent items that are complete and ready to be sold to the consumer. In order to calculate the cost of a particular item, the company must accumulate costs from all 3 categories. Depending on the nature of the product being created, a company could use job order costing or process costing. A job order costing system works best for products that are unique and produced one at a time, or for service businesses, such as lawyers or accountants. This type of costing system would be appropriate for a manufacturer of custom furniture, or in the case of custom-ordered wedding cakes at the bake shop. In this type of costing system, costs for materials, labor, and overhead are accumulated for each custom order. Overhead represents the indirect cost of producing a product or providing a service. For example, the bake shop could not operate without paying its rent, utilities, or the wages of the staff members who take the orders of walk-in customers. Total overhead costs are allocated to each job based on a predetermined rate. Let's assume that the bake shop received a special order for a 3-tiered wedding cake. In order to calculate the cost for the cake, Miss Yu Cook would need to determine the quantity and cost of each raw material needed, such as flour, sugar, baking powder, eggs, etc. The owner would also need to keep track of her labor costs to mix, bake, assemble, ice, and decorate the cake, and she would allocate a certain percentage of overhead to producing this cake. Let's say the raw materials for the cake are $12. Miss Yu Cook's labor costs are $75, and overhead is allocated at a rate of 50% of direct labor. In this situation, the cost to produce the custom wedding cake would be $124.50. $12 plus $75 plus 50% times $75. Therefore, Miss Yu Cook would need to charge her customer more than $124.50 in order to generate a profit for her business. Process costing is used for products that are similar in nature and are produced in a continuous process, as would be the case in a production line. Unlike a job order costing system, where costs are accumulated for a particular job, process costing accumulates costs through departments or processes and allocates them based on the total number of units produced in a given period of time, such as a month. In a process costing system, costs must be accumulated and transferred from process to process. For example, when a batch of cookies is mixed together, the costs would be transferred from raw materials to a work-in-process account. And when the cookies have been baked and are ready to sell, the costs would be accumulated and transferred from work in process to finished goods. When the cookies are sold to the consumer, the costs are transferred from finished goods inventory to cost of goods sold, which is an expense account. 3 steps must be completed when determining inventory costs in a process costing system. First, you must determine the number of units completed during the period, then calculate the cost per equivalent unit, and finally, allocate the cost to finished goods and the items remaining in work-in-process inventory. Equivalent units are the number of completed units in the production process, as well as the estimated percentage completion of the items in work in process. Let's assume that the bake shop completed 5,000 chocolate chip cookies in the current month and 1,000 cookies were mixed but not yet baked, 50% complete. Assume that the total material costs were $1,000 and conversion costs were $700. Conversion costs consist of direct labor plus manufacturing overhead. We know that the bake shop completed 5,000 cookies during the month, and 1,000 cookies were 50% complete, making the total equivalent units 5,500 cookies. 5,000 cookies plus 1,000 times 50% from a conversion cost perspective, and 5,000 complete cookies plus 1,000 mixed cookies from a materials perspective. The cost per equivalent unit for materials would be 17 cents, $1,000 divided by 6,000 cookies, and 13 cents, $700 divided by 5,500 cookies for conversion costs, which means the total equivalent cost per cookie would be 30 cents, 17 cents plus 13 cents. The cost assigned to the work-in-process inventory of cookies would be $170. 1,000 cookies times 17 cents for materials, and $65. 1,000 cookies times 50% complete times 13 cents for conversion costs for a total work-in-process inventory cost of $235. The bake shop completed 5,000 cookies during the month, and total cost of finished goods would be $1,500. 5,000 cookies times 30 cents. So, as long as Miss U Cookie sells the 5,000 cookies for more than $1,500, she will earn a profit. Job order costing is used for unique and specifically identifiable items, such as custom order furniture and wedding cakes, and process costing is used when making items that are identical to each other and are produced in large quantities.
In this lesson, we'll take a look at how a business keeps track of its manufacturing costs so it knows just how much to sell its products for. When a business makes its products in bulk, it can use the process costing method of figuring this out. Using process costing, the production cost of one unit of a product is calculated based on the overall cost to make a large quantity of product. For example, a business that makes organic dog food in bulk will take a look at the total cost to make each batch of dog food. It will then use this number to calculate the cost of each bag it sells. If it costs the dog food company $2,545 to make 4,000 pounds of its dog food, it can take that total production cost of $2,545 and divide it by 4,000 pounds to find the per pound price. In this case, 2,545 divided by 4,000 equals 64 cents per pound. It's important for businesses to know how much it costs to make a product. If they didn't, they wouldn't know how to price their products so they make a profit. For instance, if the dog food company didn't use process costing and blindly sold its dog food for 50 cents or even 60 cents per pound, it would be losing money and would soon close down. But since the company did its homework and performed the process costing analysis of its product costs, it knows that it needs to price its dog food above 64 cents per pound to make a profit. In this lesson, we'll take a look at how the dog food company calculates its overall cost to manufacture its product. We won't be including any journal entries, as this lesson focuses on the process itself. Calculating your production cost through the process costing method isn't that complicated. But when your product has to go through several different departments or stages, then you'll need to do just a bit of math to find your production cost. The path your product takes as it makes its way from raw materials to finished product is called product flow. For the organic dog food company, its product flow might begin with the research team, then move on to the purchasing department. After that, it reaches the kitchen department where it is made. As the dog food moves through these stages, it incurs costs associated with each department. As it relates to process costing, cash flow is how the money adds up during the product manufacturing process. Let's follow some dog food in the making to see how each department has its own costs. First, the research team brainstorms what ingredients to use. The research team also tries out various recipes and performs taste tests with its resident dogs to see which recipes are keepers. This team also performs a nutritional analysis on the food to make sure that it is healthy for the dogs. The cost of this team is $589 for the 4,000-pound batch. The per-pound cost of this department is $589 divided by 4,000, which equals 15 cents. The second department the dog food goes through is the purchasing department. This department purchases all the ingredients needed to make the dog food. The cost for this department for 4,000 pounds of organic dog food is $1,123. Per pound, it is $1,123 divided by 4,000, which equals 28 cents. The third and final department the dog food goes through is the kitchen department, where the actual dog food is made. This department has a cost of $833 to cook and make 4,000 pounds of food. Per pound, it is $833 divided by 4,000, which equals 21 cents. As the dog food moves through its various departments, the cost to make it increases. It began at 15 cents per pound with the research department. It then incurs an additional 28 cents per pound cost from the purchasing department. Lastly, it incurs a 21 cents per pound cost from the kitchen. Adding these up, we get a production cost of 15 cents plus 28 cents plus 21 cents equals 64 cents per pound. This is the process costing method of calculating your production costs. Let's review. To manage cash flow and calculate production costs for products made in bulk, companies can use the process costing method. The production cost of each product is calculated from the overall cost to make a bulk batch. As a product moves through the various departments from research to manufacturing, product flow, it incurs costs from each department. To calculate the production cost, add the cost from each department and then divide by the number of units made in the batch. In this lesson, we'll talk about the activity-based costing method. This method calculates your overhead by taking into consideration all the activities that are involved in the making of a product. For example, say you are in the business of making ice cream. What activities are needed in order to make the ice cream? You need not only materials, but also machines and employees. All of these different elements factor into your overhead cost. With the activity-based costing system, you are able to include all of these costs into your overhead calculation. You begin the calculation by listing all the activities that cost you money to make your product. These are called cost drivers. For your ice cream making business, your cost drivers might include these: setting up the ice cream making machine, buying all the ingredients, buying all the toppings, paying the necessary amount of employees, paying the business rent, along with the utilities. Once you've listed your various cost drivers, you can now separate them into groups of related costs. These groups are called your cost pools. For example, setting up the ice cream making machine is a part of the machine setup cost pool. Buying all the ingredients and toppings can be part of the materials cost pool. Paying the necessary number of employees can be part of the personnel cost pool. Paying the business rent along with the utilities can be part of the office expenses cost pool. You'll want to create a table so you can easily see your various cost pools and what the cost drivers are for each of them. Listing the cost drivers and then separating them into cost pools is a useful activity to help you clearly define the various costs that go into the making of your product. Doing this activity helps you find out both the costs that are clearly evident along with the costs that are not so evident, such as the cost to set up the ice cream making machine. Activity-based costing helps to get a more accurate calculation of your overhead. Let's review what we've learned. The activity-based costing method calculates your overhead by taking into consideration all the activities that are involved in the making of a product. This method involves identifying your cost drivers and cost pools. Your cost drivers are all the activities that you do that cost you money to make your product. Your cost pools are your cost drivers divided into groups of related costs. Grouping your cost pools and cost drivers is useful because it will help you identify all the costs that go into the making of your product, thus giving you a more accurate overhead calculation. Manufacturing companies create products to be sold to customers. In order to make a profit on their products, these companies must accurately determine how much it costs to manufacture each product. Companies do this through product costing. Product costing is the process of determining the business expenses associated with the manufacture of a product. Associated expenses include direct labor and materials and manufacturing overhead. Labor and materials costs are considered direct costs if they are incurred during the manufacture of a product and can be directly allocated to that product. Manufacturing overhead includes all other expenses incurred during the manufacture of a product that cannot be directly allocated to that product. This might include factory rent, payroll taxes on direct labor wages, and machine maintenance. These costs are also known as indirect costs. Manufacturing overhead must be accurately allocated to a product's cost for manufacturing companies to set product sales prices and determine if products are producing profits. Traditional costing systems allocate manufacturing overhead by dividing total indirect costs by a cost driver to obtain one rate to be used to allocate overhead to different products. A cost driver is an activity that controls the amount of costs incurred. For example, in a factory, the number of hours a machine runs determines how much electricity is used and how much will have to be spent on maintenance. In this example, the number of machine hours is the cost driver that controls how much electricity is used and the cost of maintenance. The fewer the number of machine hours, the less the cost of electricity and maintenance, whereas the higher number of machine hours, the more the cost of electricity and maintenance. The number of machine hours is a typical cost driver used in traditional costing systems, as is direct labor hours. Traditional costing systems are simple, but can result in overcosting or undercosting, as the manufacture of products is generally complex and influenced by more than one cost driver. Activity-based costing systems allocate manufacturing overhead by assigning indirect costs to several different cost pools, then dividing each cost pool by its associated cost driver to obtain several different rates that can then be used to allocate overhead to different products. A cost pool is a group of individual costs. Activity-based costing systems allow manufacturing companies to more accurately allocate overhead expenses to specific products, as multiple cost drivers are used. Like traditional costing systems, machine hours and direct labor hours are typical cost drivers used. Other examples include square footage used per product to allocate factory rent and maintenance, and number of purchase orders to allocate purchase department expenses. An activity-based costing rate is calculated by assigning indirect costs to a cost pool, adding the costs included in that cost pool together, then dividing the cost pool total by the cost driver. Cost pool total divided by cost driver. The result will be a dollar amount that can then be multiplied by the number of products manufactured to obtain a total product cost for that cost pool. By calculating the activity-based costing rate for multiple cost pools, a manufacturing company can more accurately determine product cost. Now let's take a look at a couple of examples. Example 1. Traditional costing. Rio Group LLC manufactures two types of widgets, widget A and widget B. The company has asked you to allocate its overhead to each product using traditional costing and direct labor hours as the cost driver. You have been given the following information. Expenses. Payroll taxes, $2,000. Factory maintenance, $5,000. Purchasing labor, $3,500. Purchasing supplies, $500. Electricity, $7,000. Factory rent, $4,500. Equipment depreciation, $3,000. Fringe benefits, $1,500. Other information. Direct labor hours, 500 widget A, 700 widget B. Machine hours, 350 widget A, 450 widget B. Purchase orders, 75 widget A, 45 widget B. Square feet used, 5,000 widget A, 2,000 widget B. Under the traditional costing system, we'd add all of these expenses together, then divide them by the total direct labor hours to obtain an application rate. $2,000 plus $5,000 plus $3,500 plus $500 plus $7,000 plus $4,500 plus $3,000 plus $1,500 equals $27,000 total manufacturing overhead. 27,000 divided by 500 hours widget A plus 700 hours widget B equals $22.50 application rate. The $22.50 application rate represents the manufacturing overhead expense to be allocated to each direct labor hour incurred during production. To complete the project for Rio Group LLC, the application rate must be multiplied by the number of direct labor hours incurred during production of widget A and widget B to obtain total manufacturing overhead allocated to each. $22.50 application rate times 500 hours equals $11,250 overhead to widget A. $22.50 application rate times 700 hours equals $15,750 overhead to widget B. Upon completion of the calculations, you will be able to tell Rio Group LLC to allocate $11,250 of overhead to widget A and $15,750 of overhead to widget B. Example 2. Activity-based costing. Using the same expenses and information from Example 1, Rio Group LLC has asked you to allocate its overhead to each product using activity-based costing. The first step would be to group the expenses into different cost pools, depending on the factors that drive the costs. Payroll taxes and fringe benefits are driven by direct labor hours and will be included in one cost pool. Factory maintenance and factory rent are driven by the number of square feet used per widget and will be included in another cost pool. Purchasing labor and supplies are driven by the number of purchase orders and will be included in yet another cost pool. And finally, electricity and equipment depreciation are driven by machine hours and will be included in the final cost pool. $2,000 payroll taxes plus $1,500 fringe benefits equals $3,500 labor cost pool total. $5,000 factory maintenance plus $4,500 factory rent equals $9,500 factory cost pool total. $3,500 purchasing labor plus $500 purchasing supplies equals $4,000 purchasing cost pool total. $7,000 electricity plus $3,000 equipment depreciation equals $10,000 equipment cost pool total. Next, the application rate must be calculated for each cost pool by dividing each pool by the associated cost driver. $3,500 labor cost pool total divided by 500 hours widget A plus 700 hours widget B equals $2.92 labor application rate. $9,500 factory cost pool total divided by 5,000 square feet widget A plus 2,000 square feet widget B equals $1.36 factory application rate. $4,000 purchasing cost pool total divided by 75 purchase orders widget A and 45 purchase orders widget B equals $33.33 purchasing application rate. $10,000 equipment cost pool total divided by 350 machine hours widget A plus 450 hours widget B equals $12.50 equipment application rate. Finally, the application rates must be multiplied by the cost driver for each of the widgets and added together to obtain total manufacturing overhead allocated to each. The application rates above have been rounded to 2 decimal places. The following calculations use the complete application rates to eliminate rounding differences. Widget A, $2.92 labor application rate times 500 direct labor hours plus $1.36 factory application rate times 5,000 square feet plus $33.33 purchasing application rate times 75 purchase orders plus $12.50 equipment application rate times 350 machine hours equals $15,120 overhead to widget A. Widget B, $2.92 labor application rate times 700 direct labor hours plus $1.36 factory application rate times 2,000 square feet plus $33.33 purchasing application rate times 45 purchase orders plus $12.50 equipment application rate times 450 machine hours equals $11,880 overhead to widget B. Upon completion of the calculations, you will be able to tell Rio Group LLC to allocate $15,120 of overhead to widget A and $11,880 of overhead to widget B. The traditional costing method results in allocation of $11,250 of overhead to widget A and $15,750 of overhead to widget B. The activity-based costing method results in allocation of $15,120 of overhead to widget A and $11,880 of overhead to widget B. As shown by these figures, the traditional costing method results in under-allocation of $3,870 of overhead costs to widget A and over-allocation of the same amount to widget B. By using activity-based costing, Rio Group LLC will be able to more accurately price its widgets and determine if each widget is creating a profit. Product costing is the process of determining the business expenses associated with the manufacture of a product. Business expenses are costs incurred in the manufacture of products and include direct costs, which are costs that can be directly associated with a product, and manufacturing overhead costs, which are costs that cannot be directly associated with a product. Manufacturing overhead costs are also known as indirect costs. Traditional costing systems allocate manufacturing overhead by dividing total indirect costs by a cost driver to obtain one rate to be used to allocate overhead to different products, while activity-based costing systems allocate manufacturing overhead by assigning indirect costs to several different cost pools, then dividing each cost pool by its associated cost driver to obtain several different rates. A cost driver is an activity that controls the amount of costs incurred. Cost pools are groups of individual indirect costs. Activity-based costing is more complex than traditional costing, but provides more accurate overhead allocation as multiple cost drivers are used. This decreases the risk of over or under costing a product.
Technology has had a massive impact on plenty of areas in business. Accounting is no different. With the development of computer-based spreadsheets that can quickly calculate otherwise cumbersome numbers, managers are able to track costs with better accuracy than ever before. This has led to a rise in the use of activity-based costing, a method of tracking costs as they are applied to each unit, batch, product line, or facility of production.
In the past, managers would lump all overhead expenses into one broad category and allocate them by one driver, usually labor hours or dollars. Now, they're able to track them more accurately than ever before by using multiple cost drivers.
First things first, we have to determine where a cost goes. That means putting it in the proper activity cost pool. An activity cost pool tells us where the cost is coming from. For example, an accounting expense would have an accounting department as the activity cost pool. From here, we can also find out the activity cost driver, which is the actual expense categorized. The accounting department may increase overhead expenses by preparing tax returns, but it may also increase expenses by making sure that employees are paid. Either one of these can be a cost driver within the cost pool of the accounting department.
Next, we have to find the activity rates. An activity rate is the cost of a particular overhead item divided by the relevant units of the cost driver. Remember earlier we talked about how costs could be tracked for multiple levels of production, or by the unit, batch, product line, or facility? This is where it comes into use. The activity rate is found by dividing cost by the number of units of the cost driver. So let's say your factory made 100,000 widgets last month and accounting spent $10,000 on paperwork for salaries. This would mean that the cost driver, number of widgets for salaries, would have an activity rate of $10,000 per 100,000 or 10 cents per widget. Meanwhile, if there was a special order that required a batch of 100 widgets to be made, but only that batch had an additional cost of $500 since the accounting department had to work on a Saturday, then each widget in that batch would have an extra activity rate of $500 per 100, or $5.
Now it's time to actually assign overhead to each unit of production. Gather up all the relevant activity costs for each item and charge them as the overhead cost for each unit. Here's where you're glad you've got modern technology. Let's just use the figures from above to keep things simple. But keep in mind that a single unit can have dozens of activity rates. Every unit in our factory would get a 10-cent overhead cost as a result of the paperwork for salaries. However, those units in the special order would get an extra $5 markup. Therefore, with just those two costs factored in, most units are only at 10 cents of overhead, while that batch of 100 units is at $5.10. Again, when it comes time to report all this information on the manufacturing overhead budget, you'll be happy that you have spreadsheets. Each unit, batch, product line, and facility gets its own subsection where each cost that's acted upon is listed. In other words, it's a lot of paperwork. However, the flip side of this is that everything is accounted for down to the penny. In this lesson, we learned how to use activity-based costing to figure out exactly how much our overhead costs really were. Activity-based costing assigns a number, known as the activity rate, for every expense that is incurred. These are assigned on the basis of per unit, per batch, per product, or facility-wide production. From there, each entry gets its own spot in determining the exact overhead cost of... Sonny, let me tell you about a simpler time, back when I worked at the local auto plant. If you've ever had a relative like Uncle Chuck start a conversation with this line, you've probably rolled your eyes and sighed, as you knew that the story would last forever and be completely boring and irrelevant. Who cares how things used to be at the auto plant? Fast forward a few years, and you're studying accounting at the state university. You're sitting in your parents' living room when Uncle Chuck sits down beside you and takes you by surprise with his infamous line. You can't escape. As you barely listen to him barrel on about unions and better wages, your ears perk up when you hear cost of production. You decide to pay attention in case the information can come in handy later in school. We used a good old traditional costing system to determine the cost of the parts we made. He continues, nowadays they have this complicated method that makes you think harder but supposedly saves you more money in the long run. And with this conversation, your next accounting class just became that much easier. Manufacturing companies assign costs to products based upon many factors. The more accurate the costs are for a product, the more accurately a company can charge customers for that product. The true cost allows companies to know the exact amount of money being used to make a product so there are no loose ends. In older days, businesses used what's now known as the traditional costing system, which assigns manufacturing costs to a product based on the volume of materials, direct labor, and direct machine hours needed to manufacture that product. The auto plant that your Uncle Chuck works at produces spark plugs used in automobiles. The volume of spark plugs being produced is directly related to the costs needed at each part of the production process. The types of costs assigned to spark plugs under the traditional costing system are machine hours, direct labor hours, and direct material costs. Let's look at an example using the spark plugs being manufactured at the auto plant. The auto plant produces 5,000 spark plugs in an 8-hour day. It takes 3 workers to operate 3 machines to produce the spark plugs. Each worker makes $50 an hour, and each machine costs the company $40 to run for 1 hour. But what if your product needs more than just a machine and someone to run it? Due to advances in technology and the need to more accurately assign costs to a process, most companies now use activity-based costing, which sees anything that has to do with making the product as an activity with a cost, not just the machinery. For example, an activity in manufacturing spark plugs could be something as simple as loading a machine with raw material, or even moving a machine. Traditional costing systems don't account for things like this. With activity-based costing, we dig into the manufacturing process to determine the number and type of activities required. Say, for instance, that after determining the remainder of the activities needed to complete the manufacturing process for all 5,000 spark plugs and assigning costs relative to the activities, you discover that it actually costs $1.57 to produce each spark plug. Even though it only costs an additional 34 cents per spark plug, which seems minimal, that's an increase of $1,700 over the course of one day producing 5,000 spark plugs. Missing this expense and not correctly allocating it would cost the company almost $500,000 over the course of an ordinary year of production. When activities are assigned to the manufacturing process, each activity and its cost is controlled by a cost driver. The cost driver in the manufacturing of spark plugs consists of the machine operating hours, which includes the cost of labor, maintenance, and power consumption of the machine. Instead of manufacturing a simple, high-volume product, imagine a business making a low-volume, complicated product like a computer. There will be all kinds of extra costs not directly related to just putting the materials together, such as engineering and testing. The need for advanced equipment to produce advanced products requires activity-based costing to accurately determine the true cost. When a product is manufactured, all the activities associated with the production of the product are collected together in an activity cost pool. Managers can accurately determine the effectiveness and efficiency of activities based upon the collective and individual activities together in the activity cost pool. Ultimately, activity-based costing has proven to be more efficient than traditional costing systems because it takes into account engineering, shipping, and other associated activities within the manufacturing process. Traditional costing is an outdated method of assigning manufacturing costs as it doesn't calculate the true cost of manufacturing because it leaves out essential steps and the costs associated with them. Activity-based costing, on the other hand, assigns manufacturing costs based upon types of activities in the process and has taken over as the currently used costing system.
Let's meet Mr. Birch. He owns Birch's Furniture Company, a small company that manufactures handmade furniture. Mr. Birch recently attended an industry conference and heard about activity-based costing as a way to ensure his costs are more accurate. He wonders if he could use this method for his business to improve costing and generate more profit. Activity-based costing, ABC, is a method of allocating indirect costs to provide a more accurate total cost of products and services. Indirect costs, also known as manufacturing overhead, are those costs that cannot be traced directly to a product, but represent costs such as rent and salaries of supervisors, which are incurred in order to manufacture a product. To calculate an accurate cost for a product, indirect costs must be allocated to each product along with the direct costs of materials and labor used in the manufacturing process. Since product pricing is based on total costs, having a good understanding of manufacturing costs will result in better product pricing and, therefore, higher profits. ABC uses cost pools to accumulate indirect costs. Cost pools represent individual costs that are influenced by the same cost drivers. Cost drivers are activities that cause the cost of a particular activity to increase. For example, running a machine that cuts wood could be an activity that takes place in Mr. Birch's factory. One of the cost pools in Mr. Birch's company might be equipment maintenance, and the cost driver for this pool could be the number of machine hours that the saw is used. The cost of maintenance would increase as the saw is used for more machine hours. Products that require more cutting and more saw use would be allocated a larger portion of the total equipment maintenance expenses. Cost pools and cost drivers will vary depending on the activities of the business. Using ABC provides management with a better understanding of manufacturing overhead, since costs are allocated based on cost drivers and not some arbitrary method. Its use leads to better product pricing, since the underlying cost to manufacture a product is more accurate. For example, using an ABC system, Mr. Birch may determine that it costs $250 to manufacture a coffee table, but he's only charging customers $260. Having better cost information would allow Mr. Birch to adjust the price of the coffee table to ensure he's making more profit. Better product pricing leads to greater profits for the company. Since manufacturing overhead is allocated on the basis of cost drivers versus an arbitrary measure, such as direct labor hours, profitability of product lines and divisions can be determined more accurately, leading to better decision-making. This is especially important in companies that use more technology than labor to manufacture their products, because allocating manufacturing overhead on the basis of direct labor hours worked or direct labor dollars may not make sense. Let's assume that Mr. Birch currently allocates manufacturing overhead on the basis of direct labor hours. Departments and products that require a large number of direct labor hours would receive a higher share of the manufacturing overhead. This could result in some departments receiving more than their fair share of manufacturing overhead, and in some cases, the product line or division may actually appear unprofitable as a result. By using cost drivers to allocate manufacturing overhead, management can get a better picture of the actual cost of producing a particular product and also its profitability. Using cost drivers also allows a company to identify business processes that are performing well and those that are not. Management can use this information to ensure resources are directed to those activities that provide value or profit to the company, and not to non-valuable activities. ABC is expensive to implement and maintain. The process of collecting data on every activity in the production process is very time-consuming in a large company that has many different processes and products. And once collected, information must be verified and entered into the company's computer system. In addition, it may be difficult to identify activities that create indirect costs, and companies sometimes have difficulty determining a cost driver for a particular process, especially if the process is complicated or has many steps involved. Additionally, the information produced from an ABC system does not conform to recognized accounting standards, such as GAAP, Generally Accepted Accounting Standards, and can therefore only be used for internal reporting purposes. This results in additional time and effort required to produce financial reporting that can be shared with external parties, such as shareholders and creditors. Mr. Birch must determine if the benefits of implementing ABC outweigh the limitations. since his company is small, it may not be worth the investment to track and measure the activity costs and drivers necessary to implement and maintain an activity-based costing system. In addition, the furniture that Mr. Birch manufactures is handmade and requires a significant amount of direct labor hours. In his case, continuing to allocate manufacturing overhead on the basis of direct labor hours is logical, given the labor-intensive nature of the furniture he manufactures. If his company mass-produced furniture using more machines and less labor, then a change in allocation method may be necessary and appropriate. While materials and direct labor costs can be traced directly to a manufactured product, indirect costs or manufacturing overhead cannot. Indirect costs include costs such as rent, salaries of factory supervisors, and maintenance costs for machinery. An activity-based costing (ABC) system accumulates indirect costs or manufacturing overhead in cost pools and allocates them to individual manufactured products on the basis of cost drivers that cause the cost of the activity to change. ABC is beneficial because it provides more accurate costing information, which management can use to set better pricing and generate more profit. Using cost drivers identifies those business processes that are performing well and those that are not, allowing management to ensure resources are used in those activities that are providing value to the company. On the other hand, implementing and maintaining an ABC system is expensive and complex, since the cost of each activity and business process must be identified and costed with all results entered into the company's computer system. Additionally, reports produced from an ABC system can only be used for internal reporting purposes. They do not comply with accounting standards and cannot be used for external reporting to shareholders or tax authorities.